Salary or dividend? As a business owner, should you pay yourself a dividend or a salary? In this video, I will share the two most common ways that how business owners like to pay themselves and what are the pros and cons between them, so make sure you stick to the end. Hey, how's it going? If you're new to this channel, thanks so much for dropping by. My name is Thomas C. Chan. We have the most Vancouver life insurance 5-star Google reviews. And this channel is to help Canadians build tax-free wealth for their retirement and to protect you and your family using solutions that Canadian banks don't want you to know about. So enjoy what I have for you and let's get started. One of the biggest questions business owners ask is, what are the best ways to pay themselves if they own a business? Now we have a couple options. The first common way is through a salary. The second is through dividends. And the third is through a shareholder loan. In today's video, I will only focus on the two first. And as always, make sure you talk to your accountant to decide which way is the best for you. First, let's talk about how the structure works. You are the key employee of your companies. You have to do certain tasks to drive the business forward, and therefore your company hires you and pay you a salary. And therefore, your salary is 100% taxable at your personal income tax, and it's also 100% in the company's expense. Now, what if I take it out as a dividend? Because you're the shareholder of your company, and usually in small business, you're the only shareholder in the company. Therefore, when company makes money and is profitable, the company can pay shareholder a bonus. Note that this bonus is not an expense, so business cannot write it off. It's a after-tax corporate money, then pay it to the shareholder. So let me show you more numbers in details. Say Peter is a chiropractor and he is the only shareholder in his business. Let's say he makes $500,000 in revenue and spends $300,000 in overhead expense. Now Peter needs $100,000 after-tax income for his own personal stuff. Let's see how the math breaks down. So in order for Peter to take $100,000 net in salary, that means he needs to have $146,000 before tax, which he can pay his CPP, which is $3,500, and his federal and provincial income tax. So that's $146,000 from his company, plus his company also needs to spend another $3,500 for the employer's side of the CPP. That means $500,000 minus $300,000 overhead expenses minus $150,000 for Peter's side. The leftover will be the profit, which is $50,000. This $50,000 will be then taxed at 9 to 12% small business tax depending which province you're in. Let's say 10% in average, so $5,000 goes to the CRA. So the total amount of tax in this transaction will be $5,000 small business tax and around $42,000 in personal income tax, plus $7,000 of CPP, which is around $54,000. Now, let's see what happens if this transaction is declared as dividend then. Like I mentioned before, dividend is a bonus to shareholder, so it doesn't count as expense. Therefore, the company have $500,000 revenue minus the $300,000 overhead expense, which is $200,000 profit. The company needs to pay the small business tax on the $200,000 first, which is $20,000. Then we have the leftover $180,000 and the company will pay Peter $126,000 in order for Peter to have $100,000 after tax money. This is a rough estimate because it depending on which province you're in, and dividend tax is another monster topic to chat in the future. Therefore, the total amount of tax will be $20,000 from the small business tax plus $26,000 from the dividend tax, which is around $46,000. As you can see, the amount of tax for both ways is very similar. The main difference is on the CPP payments, because CRA wants to make sure people to pay in fair. And like I always say, CRA is always the smartest person in the room and they always win. Okay, so if it doesn't matter for tax purpose, then what is the difference? Let's first look at the ways that most people know how to pay themselves, and that's through a salary. Everybody is familiar with this payment method, as it's the most common. The biggest benefit of a salary is that you get a steady, predictable income throughout the year. This is especially important if you're personally looking to borrow money from a bank for a mortgage or a loan. The other is that when it comes to tax time, you don't have to pay a huge tax bill as you make installment payments throughout the year. The third big benefit of paying yourself in a salary is that you create an RSP room for yourself. This helps you shelter some of that income from taxes and give you savings for your retirement, while you can use this to offset your personal income. Paying yourself a salary also means that you have to pay into the Canada pension plan, which is deducted from every paycheck. This can be seen as both a benefit or a drawback, as you don't get that money right away, but you do get that CPP benefits when you're retired. The last consideration is withdrawing a salary does reduce the overall financial results of your company, which can affect its ability to retain financing or a company loan. In other words, if you take a salary of $10,000 every month, then a bank might look at it as a liability and decide not to lend you company money, which can hammer the growth. Next, let's look at the second way to pay yourself, which is giving yourself dividends. The biggest advantage is it's the simplest way of getting money out of your corporation and to you personally. If you pay a salary, you need to set up an account with the CRA, set up the pay source deduction and remittance every month, and complete T4 forms at the end of the year. And the salary needs to be reasonable. For example, you cannot hire a janitor and pay him $200,000 per year, and when you put someone in a payroll, say $50,000, you have to pay $50,000 by the end of the year. However, dividends are payout based on share ownership. Ultimately, here is no monthly administration you need to worry about, so it can be simpler. And technically, you can pay yourself anytime, any amounts you want, and by the end of the year, all you have to do is to file a T5 form. Now, that all sounds great, but one of the big things to consider with dividend payment is you are not paying income tax every month like payroll. So when it comes to tax time, you might have a very large tax bill that you may or may not have accounted for. If you can plan and put away that money, that may not be a big deal, but more than a few business owners have been caught off guard by the amount of taxes they owe the government by the end of the year. Paying yourself through dividends also provides the greatest flexibility. When the company is doing well, you can pay out more dividend, and when it's doing poorly, you can keep money within the company. This is a great benefit, especially if your company is only 1 or 2 years old and hasn't built up steady cash flow yet, or you're in an industry that fluctuates season from season. Another reason why I like dividend is you can add your spouse as shareholder as well too. That way you have 2 shareholders to give dividend to, you don't have to pay 2 times the CPP and payroll fees. Next, you don't have to pay into the CPP with dividend payments. As we stated earlier, this can be a negative or a positive. That's roughly $7,000 per year. If you invest that money wisely, you could end up having more money for your retirement plan than if you pay into the CPP. However, if you spend all your money, you'll run into money problems in your golden years. It all comes down to how disciplined you are with your investing. One problem with dividend payment though is you won't create any RSP room, so you don't have that tax shelter for your retirement. However, there are other ways you can shelter money from taxes, and if you're interested in knowing more, feel free to talk to us for more options. Next, paying dividend doesn't count as a business expense, so it could be preferable when viewed by lenders, investors, or potential buyers. But again here, you'll want to consider your own borrowing needs. The best thing to do is look at your goals for the next 5 years. So after hearing all those info, which way should you go for? Here are a couple questions you can ask yourself first. What kind of industry are you in? Do you get paid regularly? Or there's a big fluctuation in month to month for your business? What are your financial goals in the next 2 years? Are you looking for tax optimization? Or are you looking for big personal purchase? How much do you need as personal expense and how often you need it? Therefore, remember to always talk to your accountant before deciding whether paying yourself a salary, dividends, or a combination of the two is best for you and your company. They can help you through the process and answer any questions you might have. If you're interested in a free consultation to learn how you can build tax-free wealth without market volatility and to protect you and your family using solutions that Canadian banks don't want you to know about, click the link below. You can have a direct one-on-one chat with neither my team and I will see you in the next video.